So inflation is upon us whether you live in the US, the UK and many other places around the world, and some places are a lot worse than others, for example Turkey and Venezuela. Inflation is a big concern whether you're an average consumer or an investor, and while inflation is inevitable, there are some times when inflation is higher than others. So today I'm going to talk about what is inflation and what causes it, and how you can defend against it or perhaps even profit from it. Now, inflation is a subject that is very technical and goes in depth, so I'm going to try and give you the best possible overview in this short video. If you enjoyed this video, then I'd really appreciate an early thumbs up, as it really helps with the YouTube algorithm so that my content can reach more people. Also, please subscribe and press the bell icon to be notified of the latest videos, as I upload new content every week on personal finance, investing and how to reach financial freedom. Please note the information in this video is not intended to be investment advice, and if you want investment advice, you should seek a licensed professional. Also, past performance is not indicative of any future results. Also, please do your own research, because I'm not a financial advisor, and at the end of the day, I'm just a guy on YouTube and I'm not an economist either. So let's start with, what is inflation? So Investopedia says it's the decline of purchasing power of a given currency over time. A quantitative estimate of the rate at which the decline in purchasing power occurs can be reflected in the increase of an average price level of a basket of selected goods and services in an economy over some period of time. The rise in the general level of prices, often expressed as a percentage, means that a unit of currency effectively buys less than it did in prior periods. So as a simplified example, say you have £1 this year, and with that you can buy a loaf of bread. If inflation is 5%, then hypothetically speaking, next year your loaf of bread would cost £1.05 due to inflation. Therefore, what you were able to buy with £1 one year is worth less in the next. Inflation causes issues for the average consumer on the street by diminishing purchasing power over time when they go to buy goods. So unless your income rises in line with inflation, you are technically poorer as a result. The Federal Reserve generally tries to keep US inflation at 2% annually, as it promotes spending, but it's not enough to devastate the entire economy. But as of December the 21st, 2021, the US inflation rate is currently at 6.8%, which is its highest since 1982. And the UK inflation rate is not far behind, currently at 5.1%, which is the highest since 2008. So let's start with what causes inflation. There are generally two main causes, and the first being cost push inflation. This is caused by a substantial increase in the cost of important goods or services where no suitable alternative is available. For example, if commodity prices rise, it means the cost of doing and making things goes up. One of the best examples of this is oil, because the world runs on oil. So if oil goes up, this affects nearly every industry, because nearly all factories, trucks, planes, trains, boats and other transport that ship goods and other materials all run on oil. And if oil prices go up, then these same goods and materials cost more also. And in 2021, oil has gone up over 40%. So rising oil prices affect both businesses and consumers. If the cost of raw materials rise, then businesses generally have two options. One, they pay the higher price and take lower margins, or two, they pass on the costs to consumers by raising prices and hope their sales volume doesn't go down. The second cause of inflation is demand pull inflation. This occurs in a country when demand rises but supply can't meet the demand. This could be caused by a quick increase in the monetary supply by a central bank by printing money. And when demand increases, then prices generally go up. And in these circumstances, people may be even willing to pay more for something than they normally would. Did you know that 23.6% of all US dollars in existence were created in the past year? According to this article on Nasdaq.com, all-in money printing totaled $13 trillion, of which $5.2 trillion was for COVID. So currently we are being squeezed by both cost push inflation due to supply chain constraints, rising oil prices and lack of workforces to manufacture these goods and materials, and also demand pull inflation because the Fed in the US has printed serious cash in the past year. If inflation gets out of hand and the cost of goods starts rising too fast for us as consumers to keep up with, then central banks generally step in to slow this down. They can do this by raising interest rates, which have been sitting at extreme lows for years. Currently in the UK, as at the 22nd of December, this is at 0.25%, as the UK just increased this from 0.1%. But I would suspect this will be raised again over the coming year. Currently, interest rates in the US are 0.25%, but the Fed has signaled it could raise interest rates 3 times in the coming year. Raising interest rates can make it harder for companies to access loans or pay back loans due to increased interest on these loans. This is why growth companies are often hit hard in times of inflation, because these are the kind of companies that often have debt. When interest rates rise, some investors will likely be tempted to leave more cash in the bank or move it to bonds, potentially leaving the stock market, and so selling their shares, which in turn will drive down share prices as there's less demand for stocks. So then what can you do to protect your money or even potentially make money from inflation? Looking at the past, we can see what strategies have worked well in times when there was high inflation. Firstly, the worst asset class to be in during an inflationary environment is cash, because obviously your cash is becoming worth less and less. But inflation can be a good thing in some scenarios. Inflation is actually good for fixed rate debt, because in theory, you actually pay less for the same amount of debt that you have. But obviously, if you have a high interest rate on your debt, you don't want to wait around for inflation. You still want to pay off your debt as fast as you can. Inflation is therefore good for fixed rate mortgages, because over time with inflation, you're actually paying a lot less. Also, house prices can increase with inflation as the cost to build new houses goes up, as raw materials go up in price also. And also, rental prices can go up. So if you're renting a house out, you can charge more. Now, you can either purchase real estate directly or purchase a REIT, also known as a real estate investment trust, which will invest in real estate on your behalf, and it will cost you a lot less than taking out a mortgage or buying a property outright. There are also other investments that are a good hedge against inflation. For example, gold is often seen as one of them, because people see gold as a good store of wealth, especially when money is being printed by central banks. People see gold and other precious metals as a good store of wealth due to their finite supply. Therefore, it cannot be watered down in value due to the inability to print more or make more out of thin air. If you look at history, you can see this. The last period of high inflation was between 1970 and 1980, and as you can see by this chart here, gold rocketed up, going from about $250 to over $2,000. Now, another asset class similar to this and may do well in inflation is Bitcoin or other cryptos. Now, unfortunately, this doesn't have history to prove this due to Bitcoin only being around just over 10 years. But again, this is like gold because it can't be watered down because there is only a finite number. Currently, there is just shy of 19 million Bitcoins that have been mined, but there will only ever be 21 million in existence once they have all been mined. But if you're going down this path, just remember that Bitcoin is also one of the most volatile assets out there. And if you had bought one Bitcoin back in early November for around $65,000, then that would now be worth around $45,000 about a month and a half later. So that's over a 25% drop. And actually, multiple times in Bitcoin's history, it has lost a whopping 70 to 90% of its value. Another strategy is to invest in inflation-linked bonds. These are offered by governments and are linked to inflation at a 1-to-1 rate. So as long as inflation goes up, then your investment goes up also proportionally. In the US, Treasury Inflation Protected Securities, or TIPS, and inflation savings bonds, I-bonds, are tied to the value of the US CPI and sold by the US Treasury. In the UK, inflation-linked gilts are issued by the UK Debt Management Office and linked to the UK's retail price index. Another strategy to hedge against inflation is to invest in commodities, which can be a good idea because prices of raw materials go up, and you can invest in these raw materials by using an ETC, which are exchange traded commodities. In regards to stocks, inflation can massively affect stock prices. You can see this by how well the stock market has been doing over the past few years, due to there being nowhere better to put your cash. Higher interest rates are generally correlated with lower stock prices, and the vice versa of this is also true, in that lower interest rates are generally correlated with higher stock prices. For example, you wouldn't want to put your money in a bank where the interest rate is near enough zero and where the inflation rate is higher than this and your cash is devaluing. So in the short term, inflation is bad for stocks as prices will likely go down, but this can present a good buying opportunity. But in the long term, stocks generally do really well at outpacing inflation. And generally, stocks even outperform real estate and commodities in inflation. Stocks have provided a good hedge against inflation because businesses can just increase their prices when the cost of raw materials rise. But some sectors are better at it than others. For example, goods that we need regardless of the cost, such as food, clothes, or cleaning products, generally do well, because an increase in cost will not result in a drop in demand. Companies that are highly established can just increase prices. If we look at the investing guru Warren Buffett, then he said the following types of businesses are likely to do well in high inflation. 1. A business with the ability to increase prices rather easily, even when product demand is flat and capacity is not fully utilized, without fear of significant loss of either market share or unit volume. And 2, an ability to accommodate large dollar volume increases in businesses often produce more by inflation than by real growth, with only minor additional investment of capital. So if we delve deeper into number 1, it's basically saying to increase prices without consequences. So if we use Microsoft as an example, say your entire company is trained to use Visio or some other Microsoft Office product. If Microsoft raise their prices by a few dollars, then it's often simpler to just pay the higher prices than to retrain your entire workforce to use another cheaper or free alternative software that doesn't have all the functionality that Microsoft products may. Or if you take a brand like Apple, then people will buy their products no matter what, because they have a serious brand following. If inflation hits them, then they will just raise their prices slightly. If we delve deeper into number 2, then what Warren Buffett is saying here is if you have a company that can only pull in half the profit due to inflation, then if you have a company that can increase the amount of business and scale and produce twice the output, then you're back making the same original profit again. So basically, he's saying you want companies that are growing and scalable. For example, if you took Facebook or Meta and say advertisers don't want to be charged more, then Facebook can easily just show more adverts on a web page. So perhaps when you're scrolling, you'd see 3 or 4 ads on a page rather than just 2. But saying picking stocks in times of inflation is hard is not always true. Investing in index funds is still a great strategy here, with the S&P 500 index tracking funds generally returning 7 to 8% per annum over a long period of time. So while that's not 8% every year, one year maybe 2%, another year maybe 10%, or another year maybe minus 2%. What I'm saying is overall this averages out to about 7 or 8% over a long period of time. So these are good investments over, say, at least a 10-year period. So as long as the index fund returns a higher percentage than inflation, then you're all good. Realistically, inflation will affect your investments because you will likely have less money to invest at the end of each month due to the cost of living increasing. But as inflation goes up, then hopefully so should your salary. However, your employer may not choose to do this, and generally those closer to minimum wage will likely suffer more. If you're closer to minimum wage, then your best bet is probably to either upskill or look for side hustles. If you want to check out my video on side hustles that anyone can do, then check out the link to it up here and in the description below. Or to get a pay rise from your employer, you could even ask for more responsibilities at work, or if you're reaching the limit of your current role, you could even upskill and switch industries altogether. So as I mentioned earlier, the subject of inflation goes very in depth and there's not always one simple solution of what to do. But as always, we can see that diversification is key here. So I hope you found this beginner's guide helpful. Please let us know how you plan to hedge against inflation, and are you changing your investments up, and if so, what to? I'd love to know, and I read all your comments. Also, if you enjoyed this video or got any value from it, then please smash the like button, as it really helps the channel massively. Also, if you want to learn more about personal finance or investing, I have numerous videos on this channel, so I recommend you go check them out. So please subscribe and press the bell icon so you don't miss out on any future updates. It's been Ollie from Get Keep Finance. Thanks for watching, and I'll catch you in the next one.